The stock market is currently closed, meaning we aren't seeing active tick-by-tick fluctuations on the tape right now. The last recorded regular session ended with Navitas Semiconductor trading at an exact price of $23.39 per share. This represents a solid upward movement of 5.34% during that final trading window, showing some clear buying interest heading into the weekend. However, looking at the raw price action only scratches the surface of what is happening with this specific name. While a casual glance at your typical online stock trading screen might make this look like a standard small-cap semiconductor rally, the underlying reality is far more complicated and carries a unique set of risks that the broader market seems to be mispricing. The common narrative surrounding Navitas Semiconductor right now is heavily tied to the massive build-out of artificial intelligence infrastructure. When people think about investing in the chip sector, names like NVIDIA stock or Tesla stock tend to dominate the headlines because they represent the front line of computing power and autonomous execution. The expectation among retail investors, especially those using self-investing platforms or browsing standard investing sites for high-growth opportunities, is that any company providing components to the AI ecosystem is an automatic win. Because Navitas designs advanced power chips made from gallium nitride and silicon carbide, the assumption is that they will naturally float higher on the rising tide of data center expansions. But the reality is that Navitas is currently navigating an incredibly turbulent transition, balancing a massive cash-raising program that threatens to dilute existing shareholders against their actual hard product shipments. If you pull up your individual brokerage account or check your positions on the Robinhood app, you might see the recent bump in the stock price and assume everything is smooth sailing. Yet, just days ago, the company announced a massive $500 million at-the-market equity offering program alongside the sudden resignation of a key director. In the world of online investing, a $500 million stock issuance for a company with a market cap hovering around $5 to $6 billion is an enormous fundamental hurdle. It means management is bracing for a sustained period of heavy cash burn, needing a massive capital cushion to scale up production. This is the exact type of structural tension that typical algorithmic models, like Schwab Intelligent Portfolios or basic robo-advisors, might struggle to parse immediately. They see the headline connection to the NVIDIA partner ecosystem and the high-voltage power delivery boards, but they might miss the near-term friction of share dilution. When you look at institutional activity on sophisticated trading networks like the Interactive Brokers platform, the sophisticated money isn't just buying blindly. They are carefully measuring the rate at which Navitas can convert its design wins into actual cash flow. Right now, options trading volume has been showing a heavy tilt toward call options, which explains the recent short-term bounce, but the implied volatility is sitting at exceptionally high levels. This signals that massive price swings are expected in both directions. For an investor executing a self-investing strategy through a Fidelity brokerage account or managing an individual retirement portfolio via Fidelity Iris, this volatility requires a deeper look than just chasing a green daily chart. It forces you to look closely at the balance sheet and the actual timing of their revenue generation. Let us pause for a moment to look at how different types of investors view this sector. Comment below how many shares of Navitas Semiconductor you currently hold, or if you prefer sticking to broader baskets like Fidelity ETFs or specific technology mutual funds. It is always interesting to see how individual portfolio allocations differ when it comes to high-risk, high-reward small-cap chip companies compared to mega-caps like Apple stock. To understand why Navitas is experiencing such erratic trading behavior, we have to look closely at what they actually do. The company specializes in next-generation power semiconductors. For decades, the entire electronics industry has relied on traditional silicon to handle power conversion. But as data centers grow larger and electric vehicles demand faster charging times, silicon is hitting its physical limits. Navitas steps in with gallium nitride, known as GaN, and silicon carbide, known as SiC. These alternative materials allow power supplies to run much hotter, switch faster, and operate with significantly higher efficiency. In plain terms, they keep your devices from melting while using less electricity. This is why they were invited to participate in the NVIDIA partner event for the MGX platform, focusing on high-voltage power infrastructure for megawatt-scale AI server racks. But here's where the gap between market expectation and financial reality widens significantly. While the product design is highly regarded, the older financial reports show a company that has been losing money consistently. For the full year of 2025, Navitas brought in less than $50 million in total revenue, while posting a net income loss of over $116 million. Their operating margins were deeply negative. When retail clients open up their Robinhood Investments app or look at their account balances on SoFi Invest, they are often looking at the massive growth potential of the technology, rather than these stark fundamental constraints. Navitas has been surviving on its cash reserves and its ability to raise capital from the public markets, which is exactly why that new $500 million equity program was put in place. This creates a distinct divergence in how the stock is valued. On one hand, you have a price-to-sales ratio that looks incredibly stretched compared to traditional hardware businesses, reflecting a massive premium for future AI data center integration. On the other hand, the company has managed to maintain a relatively clean balance sheet with low debt up to this point, giving them the runway to execute this strategic pivot toward high-power industrial markets. For individuals using a Fidelity mobile app or an Interactive Brokers account to place active trades, the challenge is deciding whether management can scale up production fast enough to outrun the dilution caused by their fundraising. When analyzing the trading layout, the stock has spent a significant amount of time forming a large base after a long decline from its historical peaks. Technical traders on various investing sites have pointed out that the price action has shown signs of a structural shift in early 2026, breaking out of a multi-year consolidation box. However, every time the stock attempts to mount a sustained rally toward the higher end of its 52-week range, it runs directly into the reality of supply overhead and institutional selling. Over the past few months, insider activity reports filed with regulators show zero insider purchases and a noticeable amount of insider selling. When the people running the company are clearing out shares while the company simultaneously files to sell $500 million of new stock to the public, it signals that the road to profitability might be longer and more expensive than the general public expects. Looking ahead, the future outlook for Navitas rests on a few distinct catalysts and severe risks. The primary catalyst is whether their new ultra-high voltage isolated packages can secure immediate commercial orders in the renewable energy grid and solid-state transformer markets. If these high-power sectors begin to contribute meaningfully to the quarterly revenue numbers by the end of 2026, the company could rapidly narrow its net losses and surprise the bearish analysts who currently have lower price targets on the name. This would vindicate the aggressive self-investing crowd who have been accumulating the stock on dips. Conversely, the dominant risk is that the broader semiconductor cycle remains soft outside of pure AI computing chips. If electric vehicle adoption continues to experience a temporary slowdown and consumer electronics charging demands remain flat, Navitas will be forced to rely almost entirely on data center power supplies to drive their top-line growth. If that specific revenue stream fails to materialize in the scale required to offset their massive research and development expenses, the cash burn will continue unabated, forcing them to utilize that at-the-market equity program heavily. For someone looking at their long-term wealth management strategy, this asset behaves less like a stable utility and more like an early-stage venture capital bet wrapped in a public listing. When you weigh the entire situation, the central theme is a classic mismatch between a compelling technological narrative and a fragile corporate balance sheet. The market wants to believe that Navitas is a lock to rise alongside the biggest names in tech, expecting a smooth upward trajectory because of its ties to advanced computing infrastructure. The reality, as revealed by their capital raises, executive transitions, and deep net losses, is that the business is in the middle of a high-stakes, capital-intensive re-engineering process. For investors utilizing any modern interactive brokers trading platform or reviewing their holdings across various online investing accounts, the current price stability should not mask the underlying execution risks. Navitas has the engineering talent and the partnerships to stay relevant, but surviving the financial transition while keeping early shareholders protected from heavy dilution remains the true test for this management team moving forward. Disclaimer. This video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Like, comment, and share this video to support the channel.